Did you know that US is adding $1 trillion of new debt every 100 days? That's not politics, that's math. We've already blown past 38 trillion in national debt. And guess which generation is going to get stuck with a bill? Ours, Gen Xers. We grew up with rotary phones and recessions and somehow became the first generation expected to retire last. We work hard, saved faithfully, and play by every rule. 401ks, IRAs, steady savings, all for a future that now feels stacked against us. But the truth is, the IRS has been our silent business partner all along. That 401k, it's not really ours. It's a joint venture with the government. We put in the capital, they control the tax rate. And when taxes rise, and they will, our retirement becomes their revenue stream. So the real question isn't if taxes are going up. The question is, how long we'll keep letting the IRS be our retirement partner before we fire them for good. If you ever felt like the harder we work, the more Washington wastes our money, you're not imagining it. Decades of reckless spending have turned our future into their funding source. And every deficit they create becomes another tax we'll eventually pay. But here's the good news. There's a way to protect what we've built. And it starts with understanding how the system really plays the game. Now, let's take back control, starting with 3 truths they never taught us. First, how the IRS quietly profits from every so-called tax-deferred dollar sitting in our 401ks and IRAs. Second, why exploding debt and unchecked deficits make higher future tax rates practically guaranteed for our generation. And third, the overlooked rule buried inside the tax code, IRS Section 7702, that legally lets us grow and access our money 100% tax-free for life. We'll connect every dot clearly, logically, and step by step. So by the end of this video, you'll see exactly how we can fire the IRS from our retirement plan permanently. It was October 2008. I remember logging into my 401k and just staring at the screen. Almost half of everything I worked for, gone. Felt like it was gone overnight. Back then, I was just like every other responsible Gen Xer. I believed in buy and hold. I maxed out my 401k, trusted the market, and followed every rule the experts repeated. But then the 2008 crash hit, and I realized something painful. I played by the rules, but the rules were never designed to protect us. They were designed to tax us. That was my wake-up call. Because while our generation was watching our savings disappear, the wealthy weren't panicking. They were not even on the same roller coaster. They built something different, a structure that legally insulated their money from both market crashes and future taxes. No sleepless nights, no panic selling, no hope and pray retirement plans. And in that moment, I stopped asking how to make back what I lost and started asking how to make sure it never happens again. That discovery changed everything for me. Since 2017, we've helped over 20,000 families design those same tax-free wealth strategies using the same section of the tax code the top 1% have quietly used for decades. And the irony? It's not some secret loophole or offshore trick. It's been sitting in plain sight the whole time, right inside IRS Code 7702. Here's the truth nobody told us in our 30s and 40s. When we put money into a traditional retirement account, we don't own it outright. We own a portion of it. Because every dollar in a 401k or traditional IRA comes with a silent partner, the IRS. We do the saving, we take the risk, and they decide the tax rate later. And if you don't know what future tax rate is, you don't really know your future wealth. It's like building a beautiful vacation home only to realize the government holds the keys to one of those bedrooms and can rent it out whenever they need extra cash. Every time we hear tax deferred, what it really means is tax postponed. And deferred taxes are like deferred pay. They don't go away. They just grow with interest. That's why the IRS loves these accounts. They get to tax not only what you earned, but what your earnings earned over the next 20 or 30 years. It's the greatest revenue machine they ever created because we built it for them. We don't need a PhD in economics to see where this is heading. The US government has crossed 38 trillion in debt, and it's rising by a trillion every 100 days. That's not an accounting issue. That's a math problem. And math doesn't care who's in office. At some point, those deficits will have to be paid for. And historically, Washington has only ever used one tool: higher taxes. We can debate policy all day, but here's the simple equation. More debt equals more taxes. And the largest pool of the untapped tax revenue in America today isn't corporate profits or billionaires' wealth. It's the trillions sitting in a qualified retirement accounts owned by Gen Xers and baby boomers. We've become the government's backup plan. That's why we need a new plan, one that keeps our money growing outside the taxable system. Here's the part nobody explains clearly. The strategy the wealthy have used quietly for decades. It lives inside a section of the tax code called IRS Code 7702. Buried in that section is the legal framework that defines how certain life insurance policies can accumulate wealth completely tax-free. Now, forget what you think you know about life insurance. This isn't about dying, it's about living and keeping more of what you earn while you're still here. When structured properly, an Indexed Universal Life policy, or IUL, acts like a financial firewall. It separates your money from market losses, protects it from future tax hikes, and gives you the flexibility to access it whenever you need to. Think of it as a private tax-free savings vault, where your dollars grow linked to a market index like the S&P 500 without ever being directly invested in it. When the market goes up, your policy earns growth up to a certain cap. When the market crashes, you don't lose a dime. Your floor is zero, not negative 30. You don't have to win every year. You just have to never lose. That's the power of the 7702 framework. It puts your wealth on a track that moves forward. Now, this is where things get interesting, because once your policy builds enough cash value, then you can use it as your own personal tax-free retirement bank. Instead of withdrawing money and triggering taxes, you borrow against your cash value. But here's the key. The money you borrow isn't coming from your account. It's coming against it. Your cash value stays intact, continues compounding, and the insurance company fronts you. So while your money keeps growing, you're using the insurance money for income, completely tax-free under IRS Code 7702. It's like renting dollars from your future self at a discount and keeping every penny of the growth in the process. And because these loans aren't income, they don't show up on your tax return, they don't increase your taxable income, and they don't trigger penalties, even before age 59. This is how the top 1% build tax-free cash flow, and it's fully legal, fully compliant, and sitting right inside the US tax code. It's not magic, it's math, structured legally in your favor. So let me give you a real example here. So imagine two professionals, both Gen Xers, both saving diligently. One keeps funding a traditional 401k, the other redirects part of those savings into a properly structured IUL. By retirement, both accounts might look similar on paper, say $1 million each, but here's the difference. The 401k saver still owes taxes on every dollar. At the 35% rate, that's $350,000 gone instantly. And if the tax rates rise, even more. The IUL saver, that $1 million sits completely tax-free. They can pull income to the policy loans without IRS involvement. And if structured right, that stream can last for the rest of their life. Same money in, very different outcome. The same dollar can either build your retirement or fund Washington's. The choice is yours. By the way, if you're curious how this strategy could work for you, we built a free tool to show you. It's called the IUL Custom GPT, an AI-powered assistant that runs personalized numbers based on your income, age, and retirement goals. Think of it like having your own strategist in your pocket, available 24/7. He doesn't sell products. He doesn't pitch policies. He just gives you clear, math-based answers about how an IUL could fit into your financial plan. So if you ever wonder what your real tax exposure looks like or how much more you could keep by shifting part of your plan into your tax-free growth, you can find out instantly. Just tap the link below the video, try it out, and see what your potential results would be in real numbers. Next, we're going to tackle the biggest objections people have about this strategy and why most of them are based on myths, not math. If you are like most smart Gen Xers watching this, you're probably thinking, okay, that all sounds great, but what's the catch? That's totally fair. I asked the same question the first time I heard about it. So let's walk through the three biggest myths that keep people trapped in the old system and why each one collapses the moment you see the big picture. Myth number one, if this really worked, everyone would already be doing it. That sounds logical, right? But think about this. Everyone used to smoke on airplanes too. Common doesn't mean correct. Most people are just following outdated advice that was designed for a different world. 401ks and IRAs made sense when taxes were low and pensions existed. But today, the government's $38 trillion in debt and pensions are gone. We're living in a different economy, but most people are still using their parents' playbook. And here's the real reason you haven't heard about this from your financial advisor. They can't get paid on it. Your broker earns fees by keeping your money in the market. Wall Street profits when you stay invested. The IRS profits when you withdraw. Nobody profits when you go tax-free, except you. That's why this strategy is quietly used by the wealthy, not loudly advertised to the mass. It's like flying private versus commercial. Same sky, same destination, just a completely different flight plan. Myth number two. These policies are expensive and full of hidden fees. Here's the truth. Yes, they are cost, but they're not hidden and they're not the villain. They're the price of admission to a tax-free system the IRS legally can't touch. Think of it like building a house. You wouldn't complain that a foundation costs money. You'd insist on it. That foundation keeps everything standing. In the same way, properly structured IUL costs create a legal foundation for tax-free growth. Now, here's where most people get burned. Their policies are built wrong. Most agents design for commissions, not efficiency. Big debt benefit, small funding, great for them, terrible for you. But when designed the way the top 1% do it, the debt benefit is minimized and the cash value is maximized. That flips the script. Your dollars now work for you, not the agent. A properly structured IUL is like a Tesla. Expensive upfront, but close to zero maintenance later. You're trading gas and oil changes for silent, compounding efficiency. So yes, there is cost, but it's front-loaded, transparent, and intentional. And the trade-off? A lifetime of tax-free income and peace of mind. That's not a fee. That's freedom. Myth number 3. This must be some kind of a loophole, and loopholes always close. That's the biggest fear, and it's a smart one, because most loopholes do close. But this isn't a loophole, it's the law. Specifically, IRS Code 7702. It's written in 1984, updated in 2021, to make it even more flexible for policyholders. That's nearly 4 decades of legislative endurance. And here's what's really wild. When tax laws changed in 2021, they actually expanded how much cash you could put inside of these policies. So the government didn't close the door, they made the door wider. Why? Because they want people to take personal responsibility. Every dollar you build inside an IUL is one less dollar they have to cover through Social Security or government aid. It's not a loophole, it's an incentive. And remember, Congress writes these rules, you can bet many of them have policies themselves. So if this ever changes, it won't be overnight. And history says when laws shift, existing policies are grandfathered in, meaning those who acted early are protected. That's why I always say, this isn't about the gaming the system, it's about understanding it. The IRS code is like a highway. Most people stay in a slow lane, paying tolls their whole life. The wealthy just know where the express lane is, and they use it legally every single day. So when you strip away the noise, it's really simple. It's legal, it's efficient when structured correctly, and it's not a loophole. It's a strategy hidden in plain sight. And once you see it, you can't unsee it. And that's where everything changes, because you realize the system was never broken. It just wasn't built for people who think ahead. So let's recap what we uncovered today and connect every piece of this strategy in plain English. We started by exposing the truth. Every 401k and IRA is a joint account with the IRS. You fund it, they control the tax rate. And the longer you defer, the bigger the cut grows. We saw how exploding federal debt makes future taxes mathematically guaranteed to rise, and how the hardest working generation in America, Gen X, is being quietly lined up to pay that bill. Then we found the solution hiding in plain sight, IRS Code 7702, a rule that lets us build tax-free wealth firewall inside a properly structured index universal life policy. We learned how it captures market-linked growth without market losses, how gains lock in permanently, and how your floor is zero, not negative 30. We also saw how you can access your cash anytime. No penalties, no age limits, no RMDs. Using tax-free loans while your money keeps compounding behind the scenes. And we debunked the myths. It's legal because it's written into the text. It's efficient when structured the right way. And it's not a loophole. It's a strategy designed for people who think ahead. So here's the big picture. You build wealth without giving Wall Street control. You grow it without the IRS taking a slice. And you protect it from the next market crash permanently. That's not a theory, that's the start. And sooner you understand it, the sooner you stop playing the government's game and start playing yours. So here's the truth. The window to reposition your money before the next tax wave hits is open, but it won't stay open forever. If you're a high-income professional who's done everything right, saved, invested, played by the rules, and you still feel exposed to rising taxes and volatility, it's time to make a move. You have 2 ways forward. Option 1, book your tax-free wealth strategy session with us. It's a private one-on-one call where we'll map up your income, your current exposure, and show you how to legally reposition part of your plan with tax-free growth and income, using the same IRS-backed design principles the wealthy have used for decades. Option 2, if you're not ready for that call yet, watch the next video that's queued up just right after this one, because in it, I'm going to show you the single biggest blind spot most professionals miss, the one that silently cost them 6 or even 7 figures in their life. It's not about investing anymore. It's about keeping more. And once you see it, you'll understand why 1% have never relied on traditional retirement accounts to begin with. So whichever path you take, don't wait, because taxes aren't waiting, or neither should you. You work too hard to share your retirement with the IRS, you paid enough. So book your strategy session or watch the next video that could change the way you look at your whole entire financial future. Either way, take control before the IRS takes a bigger cut. Because at the end of the day, it's not what you earn, it's what you keep. Enjoy the ride.